And fresh from technical difficulties, our buddy Todd Halterman is in the town. Welcome,
Morning.
Todd.
Good morning, everybody.
Glad to see you, buddy. It's
Great to
I
be
was wondering
seen.
if got the what's that? What's that? Pineapples on your shirt there, man?
I just came back from fishing out at my beach house for 2 weeks, and I'm still feeling a little vacationy.
Little vacationy. Okay, nice. Yeah. So
Pineapples are the sign of hospitality, and you know I'm hospitable.
yeah, and I don't want to. We already had a show on upside down pineapples. We don't want to go there.
That's a different captain.
Now, I don't want anybody to feel sorry for you having to come back to do a radio show after 2 weeks being away. But you came back from your beach house to your lake house?
Okay, maybe so.
It's tough to be Todd.
Yeah, I know. But hey, they're paid for. I'm debt free.
Nice.
Yeah.
All right, there we go. In this day and age, I would say that's good. Probably a year and a half ago, I would have said, at 3% money, do you want to be debt free?
The explosive COVID result. Actually, I take that back. I do have one home mortgage, but I don't consider it a debt because it's at 3%, and I make 6% on fixed interest on another note. So I make 3% having my house mortgage.
Something that, and I just shared this morning that we were looking at the 10-year Treasury at 4.213. So I don't know exactly, what kind of risk you have in that, but if you can get a 10-year Treasury at 4.213, I think the 2-year Treasury the last time I looked was at 5%. You're still sitting on a 2 or 3% mortgage or 4% mortgage, which is giving you tax benefits, and you can put money into treasuries. I'm not sure why anybody would want to sell.
Banks have a definition, and it's called arbitrage. And the definition of arbitrage is an automatic profit. We have insurance companies and certificates that are paying up to 7% fixed interest guaranteed. So this is a great time for people that have 3 and 4% notes to be able to make 7%, because that's how the bank used to do it to them, and is doing it to them again.
And obviously, I'm a big proponent. If you've got that 2, 3, 4% note, keep it, unless you've got other debts. Because right now Todd, you've got some scenarios where you can help people get rid of some of these debts. Now, we talk about all the time with our student loans, rsrstudentloanhelp.com, rsrstudentloanhelp.com. Don't refinance student loans. Never, ever refinance, because the government wants to help you with those anyway. But you've got some other programs that you're doing to help people get out of debt, because it's a big problem right now.
Oh, we do. And I actually helped a family last week refinance their home equity line of credit to accommodate a vehicle and a credit card. And the rate on that HELOC was more than their mortgage by quite a bit, but their average interest rate between the home equity line of credit and the underlying mortgage was still below 5%. And so we were able to wipe a lot of their debts out by doing that. We also have a program where we help people guaranteed in 9 years or less get out of debt without spending any more cash on a monthly basis than they spend right now. But we use actuarial science to help people make sure they're directing their monthly monies to the right areas. And then we show them how to pay debts off without having to come out of extra money out of their pocket, which most people don't have.
And that's a big issue right now, because I'm not a financial advisor. Sometimes I play one on TV. But, right now, one of the biggest concerns I have as a consumer advocate is, are we going to go back into a 2008 recession, not caused by real estate, but caused by consumer debt, credit cards, car payments, student loans? To me, there's a big risk of that right now.
There's a risk of default across America. There's a bigger risk for bank failure than consumer failure. Banks are having a difficulty recapitalizing all the loans they put out during COVID, both in PPP loans to business owners that the government backed, but the banks had to put their capital out. And the amount of capital that went out in the last 3 years in just mortgages before mortgage rates went up. So we're seeing a systemic problem with banking and recapitalizing, which would affect the credit markets. And 2008 was caused by bad credit markets, and that obviously also spilled over into the real estate market. So what am I saying? The chance of a 2008 level recessionary cycle is not high. So to see the drop in the economy as deep as 2008, I don't see that, but I do see some systemic issues that are going to cause us some pain. And we don't know how prolongated the recessive cycle will be, but we also know that the government knows how to utilize interest rates to help baffle the economy and cash flow. So if we see a lot of prolonged pain, we'll see legislation and Fed movements to lower interest rates to empower that economy, but we won't know how long it's going to last yet. In fact, the recessive cycle should have hit already, but it's extended because of all the money that's been printed and the money in corporate America.
So the question then becomes, if that's the case, there's no slowing of money being printed through the through the fiscal policy. The Federal Reserve through monetary policy is trying to slow things down, but they don't seem to be getting any help from the budgets.
No. In fact, it's getting worse. So the challenge is it's just kicking the can down the road, which is why nobody knows how elongated the recession cycle can go. Some economists are holding their hat on an election year that the second half of the year, the government and the Fed's going to show us how they're rescuing us, so it stabilizes the voting market. But some cracks don't feel so well, and we don't know yet. There's a lot of things to consider, including student loan payments starting back up in September. And in October, economists have pointed out that all the savings that people added up over COVID is going to be gone, and they will be, and credit card balances right now are just went over $1 trillion in America.
And the worst part about that is, I've seen the same numbers, over $1 trillion, but now I'm seeing that the average interest on that 25%.
So consumer spending is going to slow down. Student loan repayments having to start up, credit card and debts, higher interest rates, and consumer spending makes up over 65-70% of the economy.
Crazy. We're gonna have to watch that one. And obviously, we've been evangelizing rsrstudentloanhelp.com. That's a big savings. I know one person I just found cut their payments by 60%.
Wow.
Just by going and using laws that are already on the books. It's not executive orders that we have to worry about. So rsrstudentloanhelp.com. 4 numbers is all you have to put in there to figure out what it can do for you. Continue our conversation with Todd Halterman this morning. So Todd, I want to chat with you today because right now there's not a lot of good reason for people to sell a house. If you've got a 2, 3, 4% mortgage, people are not selling their houses right now to go and buy at I don't know, what did we say earlier today, that 7.3% mortgage. So one of the things that does help, and obviously I've talked about this a lot, is number one, you can use some of your equity, pay off your debts, your blended household interest rate. The fact that you've got a 2% or 3% mortgage is irrelevant when you've got 30% credit card debt. But those that are thinking about selling, and I've got a friend of mine that is selling in Southern California and moving to Idaho, and he's got a big capital gain in the departing property, but it's his primary residence, so doesn't qualify for the 1031 exchange. Are there other programs out there that he could use, easy for me to say, strategically to sell his departing property and buy something else?
Yeah, we all the time help consumers who are selling real estate or business assets not pay tax at closing, or are able to defer a majority of that tax to a later time where they can pay the tax when they can pay less tax. Oftentimes when people sell a large asset that's grown a lot, they have to pay all that tax at once, Ron, and you and I both know that big windfall causes big windfalls of tax as well. In the state of California, there's the state tax, the federal tax, the net investment Medicare tax. And these numbers just continue to rise. Not to mention that if you're on Social Security and Medicare, the Medicare cost of premiums monthly go from, in the 160 regions to 260 and then to 430, just because they sold a real estate asset and made money. So we like to help consumers not pay taxes at closing by doing financial planning. And real simple, Ron, we help set up trust entities for consumers who can put their home into the trust and then sell the home or the real estate or the business. And when the property closes, the money goes into the account and the client holds the money in that account to use however they would like. But they do not have to pay taxes on the sale until they draw the money out to use for themselves. So that is a primary way for a lot of Californians moving out of state that we've helped them above what their exemptions are. Because a primary homeowner, if they're married, has $250,000 exemption per person against the capital gains. So their gains need to be over 500,000 before we'll even consider any, what I'll call tax mitigation techniques.
So this almost for a simple guy like me, I could kind of think of this. It sounds to me, and I know it's not the same, but it almost sounds like it's a type of a 401k or IRA where you've got the capital gain, you've taken that in, but it's not really taxed right now. It's taxed at some time down the road, unless there's other strategies that you're doing then.
It defers the tax just like an IRA. That's a great analogy, actually, Ron.
Now, can I do that with any kind of a capital asset?
Most real assets, anything that's highly appreciated. We do very well with folks that have fine art. We've actually taken hundreds of thousands of dollars of art pieces and helped consumers sell, because art sales tax income tax gain starts at 37%. So we've done fine art pieces, we've done businesses, we do real estate, we've done investment assets like highly appreciated stocks. We've had somebody that bought a stock at 5,000 and it turned into 500,000. So
they bought NVIDIA, is what you're saying.
It's always knowing when to sell some, you know it.
Exactly.
Yeah. But do not put off selling an asset because you're worried about paying taxes. There are ways to help lower that or mitigate it or defer it. People just sometimes get afraid to look.
And I want to throw in there, we're not giving any tax advice here. We're not giving financial advice. The idea here is these are ideas. If you want the exact way of doing these things, give me a call at 800-306-1990. I'll put you in touch with Todd, and he gives tax advice and all these, and works with CPAs and lawyers and all that kind of stuff to make sure that everything is done straight by the book. But it might be a book that you or your tax planner has never read.
Well, this is almost 100-year-old tax laws that we use, and it is black and white. Over the last 30 years, I can point to over 25 different private letter rulings that have proven this 95 plus year tax law.
So let me ask this part of it, because obviously here in Southern California, or actually all of California, we love taxes. I mean, we prove it because we vote for the people to keep adding more and more of them to us. So a friend of mine, not in the state of California, actually recently was negotiating on buying a boat. And his method of buying the boat was the boat was owned by an LLC, and he was just buying the LLC.
Yes.
And my understanding is then there's no sales tax because it wasn't a property that was taxable because it's an LLC that he bought. Can something like that be done with real estate?
If it's done like that, then what it's called is a basis to basis transfer. So that means the person who sells the LLC is going to transfer it with the same cost basis. But it really comes down to sale price, because if you put a boat in an LLC, the boat has value. That means the LLC has value. If that boat's gone down in value, and many boats do, and most likely it has, then the sale is going to be less than what it was paid for it. So for the seller, there would actually, as an LLC, there would actually be a tax loss. So putting depreciating assets into a corporate entity can be very smart.
Interesting. Now, what about real estate? Because our real estate in Southern California, where you're talking right now, I just looked, I think it was last week, I think I looked, that the median home price in Orange County, California now is a little over $1,100,000.
Right.
So the property taxes on that is going to be astronomical. Can you do something like that with real estate? Is that allowed?
Real estate is held in a lot of LLCs across the nations, but again, it goes back to valuation and whatever it sells for and cost basis. It does not wipe out the capital gain tax. But what we do for people that hold real estate in LLCs is the LLC will transfer that piece of asset into this trust, and the trust will hold it instead of the LLC right before you close on the property. But it does not mitigate taxes whatsoever. And if it's a primary dwelling that people live in, it would be a mistake to put it in an LLC because they would lose their capital gains tax exemptions as their primary home. So you have to be very careful about how you create corporate structure.
Now, is that something that you do by yourself, Todd, or do you do that in concert with CPAs, attorneys? How do you do that?
I will not work on any of these transactions for a client without visiting and working with their CPA, an outside third-party CPA, and a tax attorney that's representing their trust. I do that for three reasons. Number one, I'm always a measure 3 times cut once kind of person. I grew up in agriculture, and Mother Nature was not kind to us, so we're very cautious. Number two, we have to make sure that we know exactly where their gains and losses are at in their investments, because sometimes the trust is not needed and can be overkill. The third thing is we have to involve everybody on the table to make sure that they understand how to work with their trust after the sale, because it's like running another company. They ask for money when they need it. They can reinvest it in other assets. And they can even reinvest it in other assets without paying taxes when they use the money. So education is paramount. So those 3 steps make sure that we don't make a mistake. We measure 3 times cut once, and people really understand what they're doing.
Interesting. I want to talk more about that. I want to get into the idea of this education, and then might we want multiple trusts? We'll talk about that as well. We're continuing our conversation. Todd Halterman is chatting with us. Trusted advisor, Todd Halterman. Not giving financial advice here today. We're giving education and information. If you want specifics, give me a call. I'll put you in touch with Todd, and you can do that. So, Todd, you were talking in the last segment, and it got to thinking, if I've got multiple assets, do I put them in multiple trusts, or can one trust handle all the assets that I'm thinking about reallocating?
Well, the thing is you've got to defend yourself. I don't care who you are. Offense sells tickets, but defense wins championships. And people just blindly continue to do the same things they do, even though the entire economy and the way the world does business has changed. And you can't do that. So you need to reallocate, you need to rebalance, and you need to understand which industries and sectors of the global marketplace is successful and profitable in up or down markets. There's always places to make money, Ron, but those people that just sit there and just hold on, it'll come back, that's laziness. You should be preparing yourself for headwinds. America has relied on diversification, and now because of banking debt and the change in global commerce, diversification does not eliminate or reduce downside risk anymore. You have to make sure you understand how to defend yourself.
That's an interesting concept, especially when we're talking with, and obviously a good portion of our audience is in California. I would say, we watch and see our real estate values have been going up so much that you start looking at it and you say, you got a 5-year appreciation of 7.45% in Orange County each year. And you think if you put 20% down on a property, and you don't need to put 20% down, but if you did, that's 35% a year on your cash appreciation or growth. You might be getting a little bit too concentrated. Is that a fair assessment?
Well, concentration becomes an issue, but the reality is some people just can't sell their home just to help harvest or protect themselves from going down. There are techniques to take money out of a home to be able to use it tax-free, and that's in your realm. But it's a difficult conversation unless it's an investment real estate asset on how to rebalance that. But with their other assets, we can counteract it. But yeah, it becomes a difficult conversation, to say the least. And California is an interesting market because when it capitulates, it really capitulates.
Absolutely. The other thing I wanted to circle back to that you mentioned in the last segment was when we're talking about some of these vehicles that you use to try and mitigate tax liability or defer tax liability. You were talking about the education aspect. I talked to quite a few CPAs and attorneys, and some of the things that you and I chat about on radio, they're like, that sounds like voodoo, Ron. That can't be legitimate. Where would one send them? Do you help educate them if they're in a transaction like this?
Well, that's the whole point. A consumer can't make good decisions without positive or proper information. And the types of work that we specialize in with trust companies is very specialized. And a lot of your common down the street CPAs that are tax preparers or general bookkeepers for businesses or real estate investors aren't knowledgeable in this realm. And you'll find a lot of attorneys or accountants that aren't knowledgeable or haven't done it before. They'll just poo-poo it and say, oh, just pay the tax and move on. I don't want you to do that. The reality is they don't know how to do it. They're afraid of doing it. They think there's a increased risk of audits, but the truth is they're wrong. They're just afraid of it because they've not done it. They don't specialize in it, and that's not something they do. And it's not their money, so they don't mind when the client pays the tax.
That's an interesting one. And I think it goes with a lot of things. That which we don't understand, we don't like. As opposed to saying, it's 100-year-old tax law, and then they have to admit that they've never heard of it.
Well, it's like a primary doctor that sees you when you're sick and does your well exams. As soon as you need an appendectomy, they send you to a general surgeon. It's not something they do. They're afraid of it. Their malpractice won't cover it. Be smart. Get second opinions, and then validate it with a third if you need to.
That's a fascinating thought right there, because it's interesting in some vocations, and as you mentioned, a general practitioner, they're pretty quick to say, something, that's not what I do, go to the specialist. Yet when you're talking to a CPA and an attorney, frequently they're saying, I don't, there's nothing like that in the code. As opposed to saying, something, I deal in general CPA work and I deal with this and this. Maybe you do need a specialist, and they feel like they're showing their own weakness. None of us want to look weak.
No, they don't want to say, I don't know. They don't want to say, I've never done it before. They don't want to say, this is not something I have knowledge in.
Do you have ways of educating them so that they don't, so that they do get on board with the idea?
Sure. If they call your office and they want information, we've got videos and interactive ebooks and the opportunity to submit a one-page form for a comparison to show the difference between utilizing some of these strategies versus just paying the tax when you sell. All of that we do at no cost. We want to make sure people are fully informed, and we like to involve their tax people because it's somebody that's been working with them forever, and why would we take that away from them?
So when we get this, and I know we're running out of time, but when we do a strategy like this, and once we get into it, is it going to, over the cost of setting all these things up, is it going to be advantageous as compared to the cost, or am I going to know what the cost is of setting this up and implementing as compared to what the cost of just paying the tax would be?
Cost is really important. I mean, it's everything. I don't want to spend money on something if it's not going to do what I need it to do, but if you pay 25 to 30% tax on a sale of an asset, and you can, for less than 0.5% of the sale, set up your structure, 0.5% is about the average cost to set the corpus up, instead of 25 to 30%. So you tell me.
Yeah, I think I'd rather pay a half as opposed to 25 or 30. That sounds like a good trade for me.
Yeah, there's a couple other ancillary fees in the establishment of it, but in general, it's way less than 1% to get things done and set up versus 25 to 30. And then you control when you pay tax, and you control how you use those assets, and you'll never have to use a 1031 ever again.
Now, when we do something like this, and I know Josh is going to kill me when I ask another question, does this going to involve the recapture of all of the depreciation we've taken?
Recapture depreciation is an issue that we evaluate up front because there are some techniques which we can mitigate that, but we have to do some strategies to help with that. So that's a very important piece to know up front.
Good deal. So basically what we've learned today is we need to call Todd. 800-306-1990 because there's a lot of questions, there's a lot of evaluation, and we're going to find out ahead of time whether it makes sense to move forward or not move forward, and then we take the next step from there. If you want to meet Todd or any of his team, give me a call, 800-306-1990, 800-306-1990.